Welcome to Your Money, Your Call. It's the bonds edition. It's the Friday night edition. It's not really bonds. We've got Roger for equities. I'm Mark Todd from the NAB. I'm joined by, as I said, Roger Montgomery from the Montgomery Funds. I don't know, did you read Chris Joyce's article about passive investing?
Yeah, so he and I have the same view. I wrote about it in The Australian a couple of weeks ago.
So you're not saying he's plagiarised you, are you?
No, not at all. But I've long said index investing is dumb investing. It's also now very dangerous investing. We'll talk about that today.
Yeah, okay. Yeah. And so, I mean, everyone would probably...
It's not what we do.
But let's talk about the Montgomery Funds.
Sure.
How's business going with
you?
Well,
by the way, let me just say we're an active manager, and we're absolute return. So we're... You know, if someone asks me whether they should invest in an index, I'm obviously going to say no.
Yeah,
or ask a barber whether you need a haircut. So things are going very well. We had a really rocky 2016 in that we only generated about a 4.5% return for year to date, and so the market's obviously up a lot more than that, but that's because we don't own resource companies and probably never will. And we're very underweight the banks for reasons that will become evident tonight. And it's all starting to roll over now, so I suspect our numbers will start looking a lot better.
And you've got a Aussie, like the funds or what?
So there's a domestic series of funds. We've got domestic long only, which is the Montgomery Fund and the Montgomery Private Fund. The Montgomery Private Fund's $1 million minimum fund by invitation only. Then there's the Montgomery Fund. Then we've got the Montgomery Alpha Plus Fund, which is a domestic market neutral fund, and then on the global side we've got the Montgomery Global Fund, which did about 27% for the year, and then its sister is, we've also got a long short, global long short, and that global long fund is the long side of the global long short fund.
Okay. So the people here who might be buying hybrids, that's a similar. It's a multi-security, so it's got equity components, but it's the same thing. If rates go up and you have a hybrid, you get a higher outcome. So if you're getting
depends on the hybrid.
No.
The NAB ones
the
are
margin.
Yeah.
The margin's the same. So if you get a margin on CBA Pearl 7 at 5.2 or Pearl 7 at 5.2, whatever the cash rate is, it's 5.2.
Sure.
You know, you've got to claim the tax. It's a cash pay, and then you claim the franking credits. But that's the same benefit. If rates go up, you get an actual natural number, a higher cash flow. In terms of your business, the array of different products that you've got around the equities, long, short, and the like.
It's really simple. There's only two strategies. It's really simple.
Market neutral, we have long only, long short, and offshore. So there's four I've just counted.
Well, no, because the strategies are we focus on quality and value on the long side. That's across all our portfolios. And then on the short side, we have a different framework. But essentially, it's only two strategies. Just that one's domestic stocks and one's global stocks, but the strategies are the same.
Do you have an FX component in the...
We have, on the global side, we have the discretion to hedge the currency. But so you could call it actively hedged, but really it's only at the outer bounds that you would ever think about either having the hedge on or not.
So what trends do you see from your clients? And I mean, in terms of the investment strategies, what are they looking at?
Well, one of the things that we know, so if we step back and think about the thematics, and that this is what we're talking about all the time to our clients, number one, you've had declining interest rates for 35 or 36 years now. Last year, US 10-year treasuries were at 1.36% in July. I took a snapshot of the screen when I saw that because I thought I'll never see that again in my lifetime. Now they're 2.33% or thereabouts. And that has resulted in cash seeming like a liability for people. So anyone who's got any money sitting in the bank earning 2%, they think, well, I've got to be in something else. So the result of that is a migration out of cash and into other assets. That's lifted asset prices across the spectrum. Everything from property in Sydney, Brisbane and Melbourne to low-digit collectible number plates to bottles of wine and art. Everything's at record highs. And that, to me, is just a risky scenario to be in because it's not sustainable. In property, for example, you've got rising supply, record high prices and record debt already. Now, those three things can't coexist for long. They will coexist for a time, but eventually something's going to give. And as a result of that thing giving, I think prices are going to come down. And on the equity side, we've got the Cape Shiller PE sitting at almost 30 right now, which is at the 99th percentile. So only 1% of occasions since about the 1800s has it ever been higher.
Which percent? What are you talking about? Which
the
one?
Cape Shiller PE on the S&P 500. Okay. So you've got asset, again, just reflecting high asset prices. And so that tells me that we've got You know, we're in a risky period. We're in uncharted waters. And you know, if we get the opportunity, we'll talk about ETFs and how I think that's driving some of these prices higher. And that means the likes of Harvey Norman, JB Hi-Fi and so on, you know, they're going to be under serious...
Hi-Fi?
Sorry?
You still hold
No, we haven't held it for a while.
Yeah, right.
They're going to be in trouble, and I saw Richard Murray from JB Hi-Fi on Wednesday, and he was asked the question, you know, are you concerned at all about this? He said, look, my job isn't to look at the economy, you know, I'm just managing our business. And then on top of that, you've got Amazon. You know, now if you look at Rebel Sport, 80% of Rebel Sport's products are already sold on Amazon. If your only offer is price and range, you're in a lot of trouble. You're in a lot of trouble.
How is it lost on the people who vote the benefit of the click? They benefit from the click. They lose their jobs at Rebel. They say, hang on a second, this is really bad, but you can go and buy that ball that you once be able to buy. So the globalisation, the economic racism has lost its army of voters because they said they haven't benefited from it. So I don't see there being a global robot wage. I don't see there being a wage saying, OK, just because you can't work, this is what will work. I mean, that is, I suppose that's the safety net that we've got. But I don't see that as being a sustainable
well, there's either an antitrust move, you know, to break these companies up because they get too big, or the taxes go up a great deal in order to fund all the people that are unemployed and displaced by it.
So then the savings become irrelevant. So if you think about it really, you say, OK, well, Amazon shouldn't come in, just go to Harvey Norman because we've got to tax it one way or the other. You know, but industry, sorry, Steve, but industry is, all industries are like a piano accordion. You know, there's fragmentation as the piano accordion comes out and everything gets broken up and disrupted. Then there's concentration, consolidation again, and then it breaks up again. That's how I've thought about most industries. And over time, if you stand back far enough, you can see that occurring over and over again. It's happening in media, television, you know, it happens all the time. Do you think that the government is at risk of doing what they did, not the last budget, which is a non-event, but the one of Abbott? Do you think there's a risk that they're going to take on the superannuation industry, fix the property market, do all the things that they think they want to try and do? Do you think can you imagine the government doing that next week?
I don't think they need to intervene in property markets because property markets will naturally correct themselves and the whole affordability thing will be solved. The idea of allowing young people to access their super or a proportion of their super to afford a property is just to give people more money to buy property, which only keeps the price high.
It's kind of crazy,
it's absurd. It's not logical, and someone like Malcolm Turnbull should know better. Yeah. You know, he's a smart guy, so that's a bit silly. In terms of tax, I think what we can do, the problem is we're churning out something like 31,000 law students a year, and there's 60,000 practising solicitors in this country. Now, they go into other industries. That's going to change dramatically because of automation. So what we need to do is incentivise young people to start businesses, to work out what Australia's really good at. The tax change that needs to happen...
That's interesting.
The tax change that needs to happen is a tax holiday for startups. You actually need to give startups no tax, like they do in Singapore and Israel and the UK. You give people a tax holiday and you say, you don't have to pay any tax on your first $300,000 profit for the first 3 years. But and that incentivises people to start businesses. I believe cash is most valuable when people don't have any. And people don't have any. So cash is going to be very valuable. And if you believe that it's a hedge or an option over lower prices, then while it's only offering you 2% returns, it's a darn sight better than minus 20. And I think the risks are rising of a very substantial erosion in asset prices. So I think the right thing is to actually sit on that cash for a while. And I'm very worried that right now most investors are taking on, are accepting bond-like returns from most assets, but taking on much higher risk than bond market risk. So there's a litany of retailers that have gone bust just since January in the United States. You know, everything from American Apparel, Sears is in trouble. You know, there's so many companies in trouble. But there are also companies that, despite Amazon's advance, are surviving and prospering. And where that's happening, it's really interesting, is where customisation is needed or where there are premium products that aren't sold on Amazon. So if you want to buy a canoe, Amazon is not interested in selling you a canoe because it's going to cost too much to
Harold, don't buy the canoe.
Right? If you want to buy, and I'll give you another example.
I'm not sure that you can't.
Yeah, maybe you can, but you know, there's a company called Dick's Sports, and they seem to be doing okay. And the reason why they're doing okay is they offer a lot of service, a lot of expertise, a great in-store experience, and they're trying to customise a lot of the products. So a compound bow, which is an archery bow, you know, you need that fitted, you need that. You can't just buy it online and send it back. You know, it's just a hassle. You go into a store, you try a whole bunch of them at once, you work out what's right for you. So that's going to go okay. What's not going to go okay is where you just, all you do is offer range, or I called it earlier, assortment, and price. So the big W's, the Targets and the Kmarts, what's their differentiation? What do they do differently? You know, they're going to be challenged. The other big issue for retail is simply the fact that we are, you know, as consumers, we are, I think, trained or indoctrinated in this idea that we're better off with lower prices. And if we pay less, we're better. Doesn't matter the product's junk and we have to throw it out and replace it later, but that's what happens.
On retail, because active versus passive.
Yeah.
Can you make the case for the active when the active has, broadly speaking, underperformed? Like it's been really rubbishy, and it's
okay. So
and they get paid a lot of money.
Let me give you some equity fund managers that are absolutely brilliant, have been brilliant for decades. You know, I'll give you a bunch of them: Fairhome, Gabelli, Wintergreen, Longleaf, Berkshire Hathaway, Pershing, Akan Enterprises, right? Greenlight and Royce. All these guys have done well over decades in the equity markets. Yep. Okay, the last 2 years they've all underperformed. Does that mean all of a sudden quality managers no longer know how to manage investments in the stock market? That has not happened. So in terms of reporting season, yes, the numbers are encouraging generally, but the prices are factoring in even better. And whether or not that's delivered is another thing. In terms of passive versus active, if you look at the Australian ASX 200, it's gone nowhere in a decade. That's not a great return. That's not a great outcome. That's not a blue chip return. And it's because large, mediocre companies that aren't growing dominate the index. The other problem that we've got is, particularly in the growth of the ETFs, index ETFs, the economics of those businesses are such that they have to be very, very large. Yep. In order to be very large, they have to invest in large companies. The concentration now, the idiosyncratic risk, which was the reason people got into them...
The numbers are phenomenal.
But people, after the GFC, people said, I don't want manager risk, I don't want idiosyncratic risk, I don't want specific company risk, you know, I want broad indices. And what they're finding now is they're jumping right back into idiosyncratic risk because all these ETFs are concentrating in particular stocks. So one example,
agree with Roger.
ExxonMobil over the last 3 years, its revenue is down 76%. Sorry, its revenue's down 46%, revenue down 76%, the oil price is down 50%, they've got a payout ratio, the dividend's greater than, just let me finish, dividend is greater than the profits and debt's up 130%. You should have shorted that 3 years ago and you would have thought you'd make money. The price is up.
It's booming.
That's concentration risk. You've got 90% turnover in IBM and about 128% turnover in Exxon, and yet you've got 3,500% turnover in the SPY ETF. So when the market's going up, that's good, but when the market goes down, how's the ETF manager going to sell enough stock to meet everyone's redemptions?